Oh my God. First day in office, your boss is telling you, okay, get that HELOC done, get the T1 and NOA, and the client's subject property is LTV 65. What is that? Are you struggling with a lot of mortgage jargon and technical terms? If yes, no worry. I'm going to give you some idea in this video. It is too much to cover in one video, so this is part 1, so stay tuned for part 2, okay? So the first mortgage jargon and technical term is MTG. What is that? I know OMG, but MTG usually when you see that, it means mortgage. And mortgage basically means that it is a loan secured by a property. A loan secured by a property is called mortgage. Okay? It's not that difficult. HELOC. H-E-L-O-C. What is that? Well, it stands for Home Equity Line of Credit. And you may ask, so what is that? Well, basically, it is a line of credit that is also secured by a property. And you may ask, okay, then tell me what is a line of credit? A line of credit, think of it as a credit card with a much lower interest rate. You can use it anytime, and you can, every time you use it, there's interest that you have to pay, but then you can repay anytime. And after you repay, you can use it again. So there's a limit. Say the limit is 100,000, and you can use 30,000 of it. And then the next day you can, if you see something that is on sale, you can use another 20,000 of it. And then, once your pay come in, you can repay, say, 15,000 of it, and so on and so forth. So it's kind of like a credit card, in terms of the usage, but it's attached to an account, a bank account, and it's secure by your property. So if you don't pay, then they will take your property. That's what it means by secure by your property. If you don't pay, the bank can take your house. Okay? A little bit more difficult than LTV. This is one of the most common terms that you will hear. LTV stands for loan to value. What is that? Well, it is not difficult. Basically, it means that the mortgage amount divided by the purchase price. Say that your mortgage amount is 600,000 and your house price is $1 million. So 600 divided by $1 million is 60%. So the loan to value is 60%. Okay? So that's that. Next, equity. What is equity? Is it, it sounds like equality, but no, it's equity. What that means is the price of the house minus the mortgage amount. So using the same example, if your house price is $1 million and the mortgage amount is $600,000, that means the equity is what? $400,000. So there is $400,000 that, in equity. And a lot of the time, the equity, when you purchase a house, it also means the down payment. When you purchase a house, a lot of the time, the equity means you have to put down how much down payment. So if you're borrowing 600,000 and you need to pay 400,000 in down payment, that's your equity. Next one, this is one of the most confusing terms that a new mortgage agent would see. They are always confused by the term and the amortization of the mortgage. So I'm going to tell you that the term is the length that the mortgage contract. So say that your client took a 3 years term mortgage. That means that the contract of the mortgage will be 3 years. If they sell the house within 3 years, they break the contract because they say they're going to stay for 3 years. If they break the contract, they will have to pay a penalty. Okay, so that means the length of the mortgage contract. Okay, what about amortization? What is that? Amortization means actually how many years you are spreading the mortgage payment into. So for example, you're paying $1,000 per month and the amortization is 30 years. That means if nothing changed within these 30 years, it will take you 30 years, every month $1,000 to pay off the mortgage, to pay it to zero. So that means that is the amortization. So the shorter the amortization period, the higher the payment, because you are divided into a smaller amount of years. So for example, if the mortgage amortization is 30 years, the payment would be lower than if the amortization period is 5 years, because you only have 5 years to pay it off. Okay, so yeah, terms is the contract length. Okay, fixed rate and variable rate. This one you might be a little bit more familiar. Basically, fixed rate mortgage means that within that same term, so using the same example, if your client chooses a 3 years terms and it's fixed, that means during that 3 years period, the interest rate for your client would not change. Only for your client, okay? Outside the market value, the market rate might change a lot. Your client might be getting a 3% right now, but 3 years later, the market people are already getting 5%, something like that. But within that 3 years, your client is getting the same interest rate. That's called the fixed rate mortgage. What about variable rate? Variable rate, as the name said, means the interest that your client is getting is fluctuating with the market, and usually in Canada that means fluctuating with the prime rate. So the prime rate is set by Bank of Canada, and if you don't know what it is, just think of it as it is the Bank of Canada rate, okay, the market rate. Okay, next one is also very confusing, the closed term versus the open term. What that means, basically a lot of the people think that the closed term means fixed rate mortgage and open terms means variable rate mortgage. This is one of the common mistake that people misunderstand. No, closed and open basically has nothing to do with whether the interest rate would change during the term. Closed means whether there will be a penalty if you break the contract. Say that you sell the property, you pay off the mortgage sooner than expected, or you win the lottery and you decide to pay it off, or something like that. But either way, if you break the contract of a closed term mortgage, yes, there's a penalty. And if this is an open term mortgage, then no, there's no penalty. That is actually as simple as that. It has nothing to do with whether the interest rate would go up or down during the term, okay? So next one is APR. What is APR? It stands for annual percentage rate. So you may ask, is this the interest rate then? No. Actually, this is a little bit more than the interest rate. This is the interest rate plus all the fee that is associating with getting your mortgage. One typical example would be appraisal fee. So say that you are getting a mortgage rate of 3.29, and then there's a $500 appraisal fee. The APR would be more than 3.29. It might become 3.31 or something like that. It is one of those things that the government try to standardize and give you a standard number so that you can go and compare different bank and with a standard number. Say that one bank charge you 3.29 for interest rate, but like $10,000 appraisal fee. Like, let's just make an extreme example. And the other is 3.39. The interest rate might be a little bit higher, but appraisal fee is $500. So you may think, okay, let me go get the 3.29% because it is cheaper, and then but with a huge fee. So if you compare the APR, the first case, 3.29 with $10,000 appraisal fee would be much higher than 3.39 plus $500 appraisal fee. So that's one way the government try to help you guys out and understand this easier, because they don't want the bank to trick the client. Okay, so that's APR. Okay, next one is subject and non-subject property. Your boss or your broker of record may always tell you, okay, what is subject? Tell me the subject property. What is that? Subject property basically means that the application that you are doing right now, the property secured by that application is called subject property. So let me give you an example of, husband and wife own 3 rental property and 1 principal residence. They are buying the 4th rental property. So which one is the subject? The 4th rental property that they are buying, which your application that you're inputting in is secured by that 4th rental property. That's the subject property. All the other 3 rental property as well as the principal residence is called non-subject property. So if someone asks you, okay, which one, there are so many addresses there. If the underwriter asks you which one is the subject property, tell them this one it is, the 4th rental property. That's the subject property. Okay? I think lastly, P&I. You may have heard about this. What it stands for is principal and interest. So what is principal and interest? Is usually the mortgage payment. So say that you're borrowing $500,000 mortgage and your monthly payment is $2,800. That's called P&I, $2,800. And within that, if you look at the calculation, the dissect the 2,800, maybe like say 2,000 of them would be interest and 800 of them would be principal. So you're, paying down the mortgage $800 per month, something like that. So that's why 2,800, this monthly payment is called principal plus interest, or principal and interest, because that's actually, if you look into detail of this, how they come up with the 2,800, that's the two portion of it, principal and interest. Okay. Slide TY and PLS SUB. That is thank you, and please subscribe to my channel. Okay, I love to talk to you about more mortgage jargon and technical terms in our next series. Okay, thank you.